Before we begin, a quick and important disclaimer. This video is intended strictly for educational and entertainment purposes. The information provided regarding insurance history, legal frameworks, and financial trends does not constitute professional financial, legal, or insurance advice. Every individual's financial situation is unique, and historical trends are not predictive of future potential outcomes. Viewers should conduct their own due diligence and consult with a licensed professional before making any decisions related to insurance products or legal contracts. Imagine for a moment that you are living in the United States in the year 1955. You have insured your colonial-style home against fire. You have insured your brand-new Buick against collisions. You likely even have a robust life insurance policy to ensure your family is provided for in the event of your untimely passing. But there is one catastrophic financial event that has a higher statistical probability of occurring than a total house fire. Yet no insurance company in the country will sell you a policy for it. That event is the dissolution of your marriage. In the mid-20th century, a divorce was not just a social scandal. It was a financial liquidation event that could instantly move a family from the middle class to the poverty line. For a woman in 1960, divorce often meant the immediate loss of her primary source of income and credit. For a man, it meant the potential for lifetime alimony and the division of assets in a legal system designed to punish, not to protect. Why did the most advanced insurance market in the history of the world refuse to touch the American marriage? Why was there a total vacuum where a safety net should have been? This is not just a question of history, it is a question of how we value the domestic contract. By the end of this masterclass, you will understand the intricate legal, social, and actuarial walls that prevented divorce insurance from existing, and you will see how the absence of this product shaped the financial destiny of millions of American families. We are diving deep into the adverse selection nightmare, the moral hazard trap, and the legal architecture of fault that made marriage the only major life risk that you were forced to carry entirely on your own shoulders. To understand why divorce insurance was an impossibility in the 20th century, we must first examine the legal landscape of the era. Before 1969, when California became the first state to adopt no-fault divorce laws, the legal standard in the United States was based on the concept of matrimonial offense. You could not simply decide that you and your spouse were no longer compatible. To obtain a divorce, one party had to prove that the other had committed a specific legal fault. These grounds typically included adultery, physical cruelty, or desertion. From an insurance perspective, this created an immediate and insurmountable barrier, known as legal uncertainty. Insurance companies thrive on predictable, quantifiable risks. They can calculate the likelihood of a 45-year-old man having a heart attack based on thousands of data points. However, they could not calculate the risk of divorce when that risk was tied to a criminal or quasi-criminal act that had to be proven in a court of law. In the mid-20th century, the legal system treated divorce like a tort or a crime. If an insurance company offered a policy that paid out upon the dissolution of a marriage, they would essentially be insuring against the commission of a fault. In the eyes of the law at the time, this was seen as a violation of public policy. There was a prevailing legal theory that providing a financial payout for divorce would actually induce people to commit adultery or simulate cruelty, just to trigger the insurance claim. Historical trends show that courts were extremely wary of any contract that could be seen as facilitating the breakup of the family unit, which was considered the foundational brick of American stability. Beyond the legal hurdles, we must look at the two primary demons of the insurance industry: moral hazard and adverse selection. These two concepts are the primary reasons why, even if the law had allowed it, the private market would have likely stayed away. Moral hazard is the idea that if an individual is insured against a loss, they are less likely to take steps to prevent that loss from occurring. In a 1950s context, insurers feared that if a couple had a $20,000 divorce protection policy, they would be less inclined to go to marriage counseling or work through their difficulties. The insurance payout would effectively lower the cost of quitting. To an actuary sitting in an office in Hartford, Connecticut in 1958, a divorce insurance policy looked like an invitation for people to stop trying. Unlike a house fire, which is usually an accident, a divorce is a choice made by one or both parties. Insuring a choice is fundamentally different from insuring an accident, and it pushes the boundaries of what is considered insurable interest. Adverse selection was an even bigger threat. In the insurance world, this occurs when the people most likely to experience a loss are the ones most eager to buy the insurance. If an insurance company offered divorce insurance to the general public in 1965, Who would be the first in line to sign up? It wouldn't be the blissfully happy newlyweds. It would be the couples who were already sleeping in separate bedrooms and arguing over the dinner table. Because the insurer cannot look into the heart of a marriage the way they can look at the engine of a car or the blueprints of a building, they have no way to weed out the high-risk applicants. This leads to a death spiral, where the premiums must be raised to cover the high volume of claims, which in turn drives away the low-risk happy couples, leaving only the doomed marriages in the pool. Eventually, the premiums would have to be so high, perhaps nearly equal to the payout itself, that the product becomes economically useless. Furthermore, we must address the socio-economic status of women during this period. Until the passage of the Equal Credit Opportunity Act in 1974, women in the United States often faced significant hurdles in obtaining credit or even having their own bank accounts without a male co-signer. In a deep dive analysis of the 20th century household budget, we see that the husband was almost exclusively the policyholder for the family. For divorce insurance to work, it would need to protect the party most at risk of financial ruin. In the mid-20th century, that was the wife. However, because women had limited independent financial standing, the loss they suffered from divorce, the loss of the husband's future earnings, was difficult to quantify in an insurance contract. The law provided a substitute called alimony, but alimony was not a guaranteed payout. It was a court-ordered obligation that was notoriously difficult to collect. Case studies from the 1950s and 60s show that a large percentage of divorced women never received the full amount of alimony or child support they were awarded. If we look at the historical data, we see that the divorce rate in the United States began to climb steadily after World War II. In 1940, the divorce rate was about 2.0 per 1,000 people. By 1946, as soldiers returned home and faced the realities of hasty wartime marriages, it spiked to 3.5. While it dipped in the 1950s, the underlying social tension was building. Yet, despite this clear and present risk to the American dream, the insurance industry remained silent. They had successfully commodified death, disability, and disaster, but they could not commodify the failure of love. This failure of the market to provide a private safety net meant that the entire burden of divorce was shifted to the state and the judicial system. The lack of divorce insurance forced the courts to become arbiters of morality rather than adjusters of claims. Another step-by-step detail to consider is the valuation of domestic labor. In an insurance claim for a destroyed factory, the insurer calculates the value of the machinery and the lost production time. In a 20th century marriage, the labor of the housewife had no recognized market value in the eyes of actuaries. Because her work was not monetized through a paycheck, the insurance industry didn't know how to replace it if the marriage ended. They could calculate the loss of a breadwinner's salary for a life insurance policy, but they couldn't calculate the loss of a domestic partner in a way that fit into a standard actuarial table. This lack of data on the economic value of the home meant that a crucial half of the risk was invisible to the financial sector. The 20th century was an era of the all-or-nothing marriage. Without insurance, the financial stakes were so high that people remained in abusive or deeply unhappy situations simply because the alternative was economic annihilation. The absence of divorce insurance wasn't just a missed business opportunity. It was a structural feature of a society that prioritized the permanence of the family unit over the financial security of the individuals within it. As we move forward in this series, we will examine how the shift to no-fault divorce and the entry of women into the professional workforce finally began to change the insurability of the American marriage. But in the mid-1900s, the divorce safety net was nothing more than a ghost in the machine of American capitalism. To understand why this ghost haunted the financial halls of the 20th century, we have to look at the very foundation of how insurance is built. It relies on a mathematical concept called the law of large numbers. In 2026, we have the benefit of massive datasets and artificial intelligence that can predict human behavior with startling accuracy. But in the mid-1900s, insurance was a game of much cruder observation. For a risk to be insurable, it generally needs to meet 4 criteria. The loss must be accidental, it must be definite and measurable, the probability of the loss must be calculable, and the loss cannot be catastrophic to the insurer. Divorce failed nearly every one of these tests. Let us step back into 1948 and imagine a man named Robert. Robert is a middle manager at a manufacturing plant in Ohio. He is a diligent provider, but he sees the social shifts beginning to occur around him. He sees his neighbors arguing late into the night. He hears whispers of marriages dissolving in the city. Robert goes to his local insurance agent, hoping to find a way to protect his assets and his children's future if his own marriage were to fail. The agent, however, would have to explain that divorce, unlike a lightning strike or a car accident, was seen by the industry as a voluntary act. In the insurance world, an accidental loss is paramount. If you could choose to trigger your own insurance payout, the entire system would collapse. This is why you cannot buy fire insurance on your home and then set it on fire yourself to collect the check. In the 20th century, divorce was viewed through the same lens of intentionality. Because one or both parties had to actively seek a divorce, it was considered a self-inflicted financial wound. This brings us to a critical structural barrier: the indemnity principle. This principle dictates that insurance is meant to restore you to the financial position you were in before the loss occurred, not to provide a profit. In the context of a 1950s marriage, how could an actuary possibly calculate what it would take to make someone whole after a divorce? The financial loss of a marriage was not just about the division of property, it was about the loss of future potential earnings, the cost of maintaining two households instead of one, and the intangible value of domestic stability. If Robert's policy paid him $50,000 upon his divorce, but his actual economic loss was only $30,000, he would have a $20,000 incentive to end his marriage. Historical trends show that insurance regulators were terrified of creating a product that made a person wealthier for having a failed relationship. They feared it would turn marriage into a speculative investment or a form of gambling. During the 1920s and 1930s, there were actually small-scale experiments and fringe ideas that resembled marriage endowments or divorce protection, but they were almost immediately shut down by state insurance commissioners. These early products were often labeled as wagers. The legal system at the time viewed any contract that could potentially encourage the dissolution of a family as a violation of public policy. This was not just a moral stance. It was a legal doctrine that prevented the private market from innovating. If an insurance company attempted to write a divorce policy, they faced the very real threat of having their license revoked for inciting social instability. Case studies from the era show that even prenuptial agreements were frequently thrown out by judges because they were seen as contemplating divorce, which was thought to undermine the sanctity of the marital contract. If a simple contract between two people was considered a threat, a multi-million-dollar insurance pool was unthinkable. The step-by-step reality of an actuarial calculation in 1960 further illustrates the problem. To set a premium, an actuary needs a stable frequency and severity. If the divorce rate in a certain demographic is 10%, the insurer can theoretically price for that. However, unlike mortality rates, which are relatively stable year over year, divorce rates are highly sensitive to economic shifts, social movements, and changes in the law. In 2026, we can look back at the historical data and see the massive spikes that occurred after the introduction of no-fault laws, but for an insurer in 1965, those spikes would have been a bankruptcy event. They would have collected premiums based on low historical divorce rates, only to see the number of claims quadruple in a single decade. This is what the industry calls a long-tail liability that is impossible to price correctly without a crystal ball. Furthermore, we must look at the specific problem of information asymmetry. Imagine if you were an insurance underwriter in 1970. A couple walks into your office. On paper they look perfect, high income, steady jobs, no criminal record. But inside the home, they have not spoken a kind word to each other in 5 years. They know the marriage is failing, but you, the insurer, do not. If you sell them a policy, you are taking on a 100% certainty of loss while charging them a premium based on a 10% probability. This is the essence of adverse selection. Because there was no objective way to measure the health of a marriage, no blood test for affection, no inspection for emotional rot, the insurer was always at a disadvantage. They were essentially flying blind into a storm of claims they could never hope to cover. The social stigma of the era also acted as an invisible tax. In the mid-20th century, the cultural pressure to maintain a successful marriage was so high that admitting you needed divorce insurance was akin to admitting your marriage was already failing. For many, even considering the product would have been seen as a lack of faith in their partner. This prevented the formation of a large, healthy risk pool. In insurance, you need a vast majority of people who will never use the product to pay for the few who will. If only the people who suspected they would get a divorce bought the insurance, the pool would be insolvent from day one. Consider the case study of the late 1930s, during the tail end of the Great Depression. Economic data shows that divorce rates actually fell during this period, but not because people were happier. They stayed together because they simply could not afford to leave. The family unit was the only social safety net available. Had divorce insurance existed then, It might have provided an exit ramp for millions, but it also would have faced a massive wave of claims as people sought to escape the financial trap of their households. The industry saw this volatility and realized that marriage was not a risk that could be managed. It was a social variable that was too tightly linked to the overall health of the economy. But what happens when the very laws that made divorce insurance impossible begin to crumble? What happens when the state stops asking who is at fault and starts asking how to divide the spoils? As we move toward the end of the 1960s, a legal revolution was brewing that would change the definition of marriage from a permanent sacrament to a dissolvable contract. This shift promised to make divorce more predictable, but instead, it created a new kind of financial chaos that the insurance industry was still not ready to handle. The transition from fault to no fault did not solve the problem of divorce insurance. It merely changed the nature of the gamble. In the next part, we will explore the secret history of the first no-fault laws and how they turned the American courtroom into a financial battlefield, creating a desperate need for a product that still did not exist. We will look at how the disappearance of the matrimonial offense created a vacuum that left thousands of families in a state of legal and financial limbo, and why the insurance giants of the era watched from the sidelines as the American family began its most radical transformation in history. The year 1969 marked a seismic shift in American jurisprudence. When Governor Ronald Reagan signed the Family Law Act in California, he effectively ended the era of the matrimonial offense. On the surface, this should have been the green light for the insurance industry. If divorce was no longer a matter of crime or punishment, but a civil termination of a contract, it should have been as insurable as a partnership dissolution in a business. Yet the opposite occurred. The move to no-fault divorce actually terrified the underwriting departments of the major insurance carriers, even more than the old system did. Under the fault-based system, there was a high bar of entry. You had to have evidence. You had to have witnesses. You had to go through a public trial that was so grueling and shameful that many people stayed married simply to avoid the spectacle. This high barrier acted as a natural deductible for the insurance industry. It suppressed the frequency of the loss. When that barrier was removed, the floodgates opened. Between 1960 and 1980, the divorce rate in the United States more than doubled. For an insurance company, this is the equivalent of a city where the fire department suddenly stops putting out fires. The frequency of the loss became so high and so volatile that no premium could be high enough to sustain the payouts. Imagine if you were an insurance executive in 1973 looking at the historical trends. You see a line on a graph that is almost vertical. Every time a new state adopted no-fault laws, the number of filings spiked. If you had issued a policy in 1968 based on the old fault-based statistics, your company would have been insolvent by 1975. This volatility is the primary reason why the private market remained paralyzed during the greatest period of social change in the country. Let us look at a specific case study to understand the financial reality for the American family during this transition. Imagine a woman named Linda in 1974. Linda is 38 years old and has spent the last 15 years as a stay-at-home mother. Her husband, James, works as an engineer. Under the old laws, if James wanted a divorce, he would have had to prove Linda had committed some form of misconduct. If he could not prove it, the marriage remained intact, and James remained financially responsible for the household. With the advent of no-fault laws, James could simply state that the marriage was broken beyond repair. Linda, who had done nothing wrong in the eyes of the law, suddenly found herself facing a 50% reduction in her household income. In 2026, we might look back and assume that some form of income protection insurance would have existed for someone like Linda. But in 1974, the insurance industry had no way to account for the lost wages of a housewife. Because she did not have a paycheck, there was no indemnity to be paid. The insurance industry's obsession with a documented paper trail of income meant that the domestic labor of millions of American women was essentially uninsurable. Linda was facing a potential outcome of total financial insecurity, and there was no product on the market designed to catch her. This led to what sociologists later called the feminization of poverty. The lack of divorce insurance meant that when the law changed, the most vulnerable members of the household were left to fend for themselves in a legal system that was still trying to figure out how to value a non-monetized life. Step by step, the financial liquidation of a marriage in the 1970s became a nightmare of asset valuation. Before no fault, the innocent spouse often received the bulk of the assets as a form of compensation. In the no-fault era, the concept of equitable distribution or community property became the standard. This meant the marital home, the primary asset for most Americans, often had to be sold to split the proceeds. If a divorce insurance policy had existed, it would have needed to cover the liquidation loss, the cost of selling a home in a hurry, moving to a new area, and the loss of equity. But insurance companies only like to cover physical damage to a home, not the economic damage caused by a change in its title. Furthermore, the 1970s saw the rise of the pension and the 401k. These were complex financial instruments that were often held in the name of the husband. When a divorce occurred, the courts had to decide how to value a future stream of income that might not be paid out for another 20 years. This created a massive actuarial challenge. If an insurance company were to offer a policy, would they pay out a lump sum in 1975 for a pension loss that would not be realized until 1995? The time value of money and the uncertainty of future employment made this a nightmare for risk assessment. In 2026, we have sophisticated tools to value these future interests, but in the mid-70s it was often guesswork. We must also consider the concept of the migratory divorce. Before no-fault laws became universal, states like Nevada marketed themselves as divorce havens. A person could travel to Reno, stay for 6 weeks to establish residency, and get a quick divorce under Nevada's more liberal laws. This created a jurisdictional arbitrage that insurance companies hated. How can you price a policy for someone living in New York if they can simply fly to Nevada to trigger the payout under a different set of rules? This lack of geographic uniformity made it impossible to create a national insurance pool. The historical trends show that until the laws became relatively uniform across the United States, the legal loopholes made the risk of divorce completely unmanageable from an underwriting perspective. Imagine if a policy did exist and it was called marital stability insurance. To prevent the moral hazard we discussed earlier, the insurer might require a 5-year waiting period before any claim could be filed. But even then, the insurer faces the problem of the intervening variable. What if the economy crashes, leading to higher stress in the home, which in turn leads to more divorces? This makes divorce insurance a correlated risk, much like a flood or an earthquake. If a recession hits, thousands of people might file for divorce at the same time. Private insurers avoid correlated risks because they can wipe out the company's reserves in a single event. This is why flood insurance is often backed by the federal government rather than private carriers. In the 20th century, the American government was willing to back home loans and student loans, but it was not willing to back the stability of the American marriage. As the 1970s came to a close, the absence of a financial safety net for divorce led to a massive increase in litigation. Lawyers became the adjusters of the matrimonial loss. Without an insurance company to pay out a predefined benefit, every dollar had to be fought for in a courtroom. This turned divorce into an adversarial process that drained the very assets the couple was trying to divide. The legal fees alone often consumed 10 to 20% of the total marital estate. From an efficiency standpoint, the system was a disaster. It was the most expensive way possible to settle a financial contract. But there was one group of people who were hit even harder by the lack of insurance: the children. As the 1980s approached, the focus shifted from the division of property to the ongoing financial support of the next generation. The failure of the private insurance market to provide for child support in the event of a parental split led to a massive expansion of state power. This shift created a new era of enforcement, surveillance, and government intervention that redefined the relationship between the American family and the state. In the next part, we will look at the 1980s, the decade of the deadbeat dad and the aggressive rise of the child support enforcement system. We will explore how the government tried to fill the vacuum left by the insurance industry, and how this created a new form of social insurance that was far more intrusive and punitive than any private policy could have been. We will also reveal the one secret attempt by a major financial institution to launch a marriage endowment in the mid-80s, and the shocking reason why it was shut down before the first policy could even be sold. The transition into the 1980s brought about a radical shift in how the American public viewed the financial contract of marriage. If the 1970s were about the legal liberation of no-fault divorce, the 1980s were about the brutal economic consequences of that liberation. This was the era of the high-flying Wall Street executive, the rise of the dual-income household, and the sudden realization that the state was no longer willing to foot the bill for broken homes. As we look at this through the lens of 2026, we see a decade where the insurance industry had its best opportunity to intervene, yet it was precisely during this time that a new, more rigid system emerged to take its place: the state-mandated child support enforcement complex. Imagine a man named Mark in 1984. Mark is a mid-level executive at a growing tech firm in Northern California. He represents the aspirational upper middle class. When Mark and his wife, Sarah, decide to divorce, they are entering a landscape where the rules of engagement have changed. In previous decades, a man in Mark's position might have paid alimony for a set period, but the enforcement was often lax, and the social expectations were centered on his ability to provide a one-time settlement. But by 1984, the United States was grappling with a massive increase in the number of single-parent households living below the poverty line. The response was the Child Support Enforcement Amendments of 1984. This legislation required every state to improve its child support enforcement or face a loss of federal funding. Step by step, the 1984 Act turned the state into a collection agency. It mandated that states implement income withholding for child support payments. From an insurance perspective, this was a revolutionary development. In a normal market, if a risk becomes too high, an insurance product emerges to mitigate that risk. But the 1984 Act created a form of social insurance that was involuntary and punitive. Instead of a private company collecting premiums to pay out a benefit, the government began garnishing wages. This effectively crowded out any potential for a private divorce insurance market. Why would an insurance company step in to provide a safety net when the government had just created a system that forcibly extracted the payout from the policyholder's own paycheck? Historical trends show that this move significantly altered the risk-reward calculation for any private financial institution looking to enter the marital space. The decade also saw the rise of the deadbeat dad narrative in the American media. This cultural phenomenon created a massive social hurdle for any insurance product. Imagine if a company had tried to market a policy that paid out child support in the event of a divorce. In the eyes of the public and the regulators of 1986, such a product would have been seen as an escape hatch for deadbeats. The fear was that a man could simply buy a policy, walk away from his family, and let the insurance company handle the financial fallout. The moral hazard was no longer just a theoretical problem for actuaries. It was a front-page political issue. The potential outcomes of such a policy were viewed as a direct threat to the newly established state enforcement mechanisms. However, behind the scenes, a major financial experiment was being discussed. In the mid-1980s, a group of venture capitalists and insurance innovators, led by figures like Arthur Lipper III, began floating the idea of a marriage endowment. This was not called divorce insurance. That term remained a marketing death wish. Instead, it was framed as a long-term savings and protection plan. The structure was ingenious. A couple would pay into a mutual fund-style account starting on their wedding day. If they stayed married for 25 years, they would receive a massive anniversary payout. But, and this was the key, if they divorced before then, a portion of the fund would be immediately triggered as a bridge payment to help the lower-earning spouse transition to a new life. This marriage endowment was designed to solve the adverse selection problem by attracting happy couples with the promise of an anniversary windfall. It used the payout as a carrot to encourage stability, while the bridge payment acted as the insurance component. But when this proposal reached state insurance commissioners, it was met with a brick wall of 19th-century legal doctrine. Regulators in states like New York and Illinois ruled that such a product was essentially a wager on a marriage. They argued that because the policyholder had a financial interest in the dissolution of the contract to access the funds, it violated the principle of insurable interest. The shocking reason it was shut down was not because it was a bad financial model, but because it was too honest about the economic reality of divorce. The legal system in 1987 still insisted on the fiction that marriage was a permanent sacrament, even as the divorce rate hit historic highs. To understand the depth of this failure, we must look at the data from the 1980 to 1982 recession. During this downturn, divorce rates actually saw a slight plateau, but the severity of the financial loss for those who did divorce was catastrophic. Foreclosures on marital homes skyrocketed. Private insurance companies, which were already reeling from the volatility of the interest rates during the Volcker era, were in no mood to take on the most volatile risk of all, the American heart. Step by step, the insurance industry focused on more rational risks like commercial liability and life insurance, leaving the domestic sphere to the lawyers. Consider a case study of a dual-income couple in 1988, which we will call the Miller family. Both work in the burgeoning service economy. They have a mortgage, 2 car payments, and a shared retirement plan. In the absence of divorce insurance, a split in 1988 meant the immediate destruction of their combined credit rating. Because credit was increasingly tied to the household unit, a divorce often triggered a cross-default on their lifestyle. There was no product to ensure their joint creditworthiness. This created a massive hidden cost to divorce that the insurance industry refused to quantify. If the Millers had a policy that protected their credit score or provided a liquid cash infusion to pay off shared debts, the long-term potential outcomes for their children would have been vastly improved. Instead, they were forced into a decade of financial recovery. The 1980s ended with the American family more financially exposed than ever before. The state had stepped in to enforce payments, but it had not stepped in to provide security. The private market had tried to innovate with the marriage endowment, only to be crushed by a legal system that was allergic to the commodification of the family. This left a void that would be filled by a much more aggressive and controversial financial tool in the 1990s. As we move into the next decade, we will witness the explosion of the prenuptial agreement. What was once a tool for the ultra-wealthy became a middle-class necessity, but it brought with it a new set of legal and emotional wars. We will explore how the prenup became the de facto divorce insurance of the 1990s, and why the insurance industry's continued refusal to participate in the market led to a specialized legal industry that made millions off the very risks that should have been covered by a $50 a month premium. We will also examine the contractual Cold War that erupted in American bedrooms and the 1990s court case that almost changed the definition of marriage into a pure business partnership. The 1990s arrived with a paradoxical energy that redefined the American dream. While the country was entering the longest period of peacetime economic expansion in its history, the domestic front was becoming a theater of high-stakes financial warfare. Wealth was being created at record speeds via the early internet boom and a roaring stock market. Yet the statistical probability of that wealth being halved in a courtroom remained a constant shadow over the American household. As we look back from 2026, we can see that the 1990s represented the era where the vacuum left by the insurance industry was finally filled, not by a protective policy, but by a defensive legal instrument, the prenuptial agreement. In the absence of a formal insurance product, the private sector did what it always does when a risk is left unmanaged. It found a workaround. Historically, prenuptial agreements were seen as the exclusive tool of the ultra-wealthy, the Rockefellers and the Vanderbilts, who needed to protect dynastic fortunes. But in the 1990s, the self-made class of the dot-com era and middle manager professionals began to see their future earnings as a risk that needed to be hedged. However, unlike insurance, which is a third-party risk transfer where you pay a company to take the hit, a prenuptial agreement is an intra-party risk reallocation. It is effectively DIY insurance, where the two partners decide who loses what before the loss even occurs. To understand why this was an inferior substitute for actual insurance, we must look at a landmark legal shift from 1990, the case of Simeone versus Simeone in Pennsylvania. Before this ruling, many American courts operated under a paternalistic doctrine. They often viewed women as the weaker party in marriage who needed special protection from bad contracts. If a prenuptial agreement seemed unfair or if the woman didn't have independent counsel, a judge would often simply throw it out. But the Pennsylvania Supreme Court in 1990 changed the trajectory of the American family. They ruled that because women had achieved professional and legal equality, they were to be treated as equal contracting parties. This meant that a deal was a deal, no matter how lopsided it turned out to be. This legal shift was the catalyst for the contractual Cold War that erupted in American bedrooms. Imagine a case study involving a couple we will call David and Jennifer in 1994. David is a software engineer with a small stake in a startup that might one day be worth millions. Jennifer is a marketing executive with an upwardly mobile career of her own. As they plan their wedding, David's lawyer suggests a prenuptial agreement to protect his intellectual property and stock options. In a world with divorce insurance, this conversation would be irrelevant. David would simply pay a monthly premium to an insurance company, and if the marriage ended, the insurance company would pay Jennifer a displacement benefit or bridge salary to ensure her lifestyle was maintained. The risk would be offloaded to a multi-billion-dollar pool of policyholders. But because no such product existed, David had to ask Jennifer to sign a document that essentially said, "If we fail, you get nothing from my success." This created an immediate emotional tax. Jennifer felt insulted, as if the marriage was being built on a foundation of planned failure. David felt defensive, as if his hard work was being targeted by future litigation. This is the core tragedy of the 20th century insurance vacuum. It forced couples to become their own adversaries before they even said their vows. The potential outcomes were often binary. Either someone was protected and the other was exposed, or both were exposed to the massive costs of the legal system. Step by step, The 1990s saw the legal profession take over the role that should have been played by insurance adjusters. If you had a car accident in 1995, an adjuster looked at the damage, checked the policy, and wrote a check. It was a bureaucratic, non-emotional transaction. But in a divorce without insurance, every single asset, the 401k, the home equity, the shared stock portfolio, and even the future value of a professional degree, became a point of contention. The lawyer problem became the primary reason why insurance companies continued to stay on the sidelines. In a standard insurance claim, the insurer is usually on your side, defending you against a third party. But in a divorce, the third party is the other co-insured spouse. An insurance company looking at this in 1997 saw a nightmare where they would be paying for the legal fees of both sides to fight each other over the insurer's own money. This is what the industry calls moral hazard on steroids. Furthermore, the 1990s introduced a new kind of marital asset that was notoriously difficult to value: marital human capital. Case studies from this era show courts grappling with how to divide the value of an MBA or a medical degree earned during the marriage. If Jennifer worked to put David through medical school, she was investing in his future earning capacity. If they divorced 3 years later, how could that investment be recouped? Without an insurance product to buy out her interest in his future earnings, the courts were forced to use alimony as a clunky, often ineffective substitute. Historical trends show that alimony awards were becoming rarer and shorter in duration, leaving the investor spouse with no way to recover their contribution. An insurance policy could have easily quantified this as a return on domestic investment payout, but the actuarial tables for such a thing simply didn't exist. By the late 1990s, the divorce rate had plateaued at its famously cited 50% mark. While this stability should have made the risk more calculable for insurers, the sheer size of the potential losses had grown. The dot-com millionaires were now paper billionaires, and the volatility of their assets made them uninsurable. If an insurance company had written a policy for a Silicon Valley executive in 1998, they could have been on the hook for a payout in the hundreds of millions by the time the bubble burst in 2000. The correlation between economic market crashes and marital stress meant that divorce insurance would have been a systemic risk. Just when the insurer would need to pay out the most claims, their own investment portfolios would likely be tanking due to the same economic downturn. Imagine if you were a risk manager at a firm like AIG or State Farm in 1999. You are looking at a society that is increasingly litigious, where the definition of marital property is constantly expanding, and where the insured event is a choice made by the policyholders. You would see a market that is desperately underserved, but you would also see a risk that is fundamentally unpriceable. The lack of divorce insurance in the 20th century was not a failure of imagination. It was a rational response to a legal and social system that was too volatile for the cold, hard math of insurance. This left the American public in a state of constant financial anxiety. Every marriage was a naked risk. The only way to protect yourself was to hire a more aggressive lawyer than your spouse or to never get married at all. A trend that began to accelerate as the century drew to a close. However, just as the 1990s were ending, a small group of entrepreneurs in North Carolina thought they had finally solved the math. They believed they could bypass the fault laws, the moral hazard traps, and the lawyer problem to create the world's first true divorce insurance policy. In the next part, we will uncover the rise and fall of Safeguard Financial, the first company to actually attempt to bring divorce insurance to the American masses in the early 2000s. We will look at their specific wedlock policy, the secret formula they used to try and outsmart the actuaries, and the bizarre reason why the very people who needed the insurance the most were the ones who ultimately destroyed the company. We are moving from the era of no insurance into the era of the failed experiment, and the lessons learned from this collapse would change the way we think about the value of a wedding ring forever. As the calendar flipped to the year 2000, the ghost of the 20th century insurance vacuum finally met its first real challenger. The world was moving into an era of hyperfinancialization, where everything from weather patterns to celebrity reputations was being turned into a tradable risk. It was in this environment that a company called Safeguard Financial, based in North Carolina, attempted to do what the giants of Hartford and New York had deemed impossible for 100 years. They launched a product called Wedlock. To understand why this experiment is critical to our retrospective, we have to look at how they tried to solve the structural problems we have discussed: moral hazard, adverse selection, and the indemnity principle. This was the first time an entity tried to apply the cold, hard logic of casualty insurance to the volatility of the American heart. Looking back from the vantage point of 2026, the wedlock experiment looks like a primitive beta test for a world that wasn't ready to face its own statistics. Safeguard Financial's founders realized that they couldn't just offer a standard insurance policy, because they would be shut down by state regulators for promoting gambling or violating public policy. Instead, they framed the product as a form of supplemental insurance, similar to how one might buy extra coverage for a specific disease or an accidental death. They broke the coverage down into units. Each unit cost approximately $15.99 per month and provided a $1,250 payout in the event of a divorce. A couple could buy as many units as they wanted, theoretically allowing them to build a safety net that could cover legal fees, moving costs, or the loss of a second income. But how did they solve the 48-month problem? Historical trends in the insurance industry showed that most divorces occurred within the first few years of marriage. To combat the 20th century demon of adverse selection, the idea that only people planning to divorce would buy the insurance, Safeguard implemented a mandatory 4-year waiting period. This was their elimination period. If you divorced within the first 48 months of the policy, you received nothing. The logic was that if a couple could stay together for 4 years while paying premiums, they weren't gaming the system or buying the policy with the intent to immediately file for divorce. Step by step, this was designed to filter out the high-risk, bad-faith applicants and create a stable pool of good marriages that would fund the eventual payouts for the few who failed. Imagine a case study from 2002. We will call them Mike and Susan. They are a young professional couple getting married in a suburb of Chicago. Mike's parents went through a traumatic, financially draining divorce in the 1980s, and he is determined not to leave his future to chance. He sees an advertisement for wedlock and decides to buy 20 units of coverage. This costs him roughly $320 a month. In his mind, he is building a $25,000 divorce fund that will be there if the unthinkable happens. For the first 4 years, Mike and Susan are the perfect policyholders. They are paying into the pool, and the insurance company is using those premiums to build their reserves. From an actuarial standpoint, Mike and Susan are the low-risk participants that the 20th century insurers claimed didn't exist. However, the experiment hit a wall of regulatory reality that dated back to the 1920s. In 2010, the Illinois Department of Insurance launched an investigation into Safeguard Financial. The regulators weren't looking at whether the math worked. They were looking at whether the product was legal. They invoked the same arguments we saw in the mid-1900s, that divorce insurance was a wagering contract on the duration of a marriage. Because the payout was triggered by a voluntary act, filing for divorce, the state argued that it incentivized the dissolution of the family. Even with the 48-month waiting period, the government viewed the policy as a financial reward for failing at marriage. This was a classic clash between modern financial risk management and traditional legal morality. The data from this period reveals a fascinating psychological trend. Even though the product was available in most states, the take-up rate was incredibly low. Why? Because of a concept called optimism bias. In 2026, we have a much more cynical, data-driven view of relationships, but in the early 2000s, people still suffered from the "it won't happen to me" syndrome. Research showed that while people acknowledged that the national divorce rate was 50%, 90% of newlyweds believed their personal risk was zero. This created a massive marketing failure. The only people who were rational enough to buy divorce insurance were the ones who were already worried about their marriage, which brought the problem of adverse selection back to the forefront. The happy couples who were needed to balance the risk pool felt that buying the insurance was a bad omen or a lack of trust. Furthermore, we must look at the unit value problem. A $1,250 payout per unit sounds reasonable on paper, but in the reality of a 21st century legal battle, it was a drop in the bucket. Case studies of contested divorces in the mid-2000s showed that the average cost of a legal defense was upwards of $15,000 to $20,000 per person. To truly insure against the total loss of a divorce, a couple would have needed to buy dozens of units, making their monthly premium higher than their car insurance or even their health insurance. The economics of the product simply didn't scale for the middle class. It was too expensive for the protection it provided, and the protection it provided was too small for the risks involved. By 2011, Safeguard Financial and its wedlock product essentially vanished. The company faced mounting legal fees from state regulators and a pool of policyholders that was increasingly skewed toward high-risk individuals. The death spiral we discussed in Part 2 finally claimed its first victim in the modern era. The collapse of wedlock proved that you could not solve a social and legal problem with a purely financial product if the underlying laws and culture remained hostile to the idea. The insurance industry watched this failure from the sidelines and felt vindicated. To them, the safeguard disaster was proof that marriage was, and always would be, an uninsurable risk. But did the risk go away? Not at all. As we look at the historical trends following the collapse of the first divorce insurance company, we see that the risk didn't disappear, it just moved. It moved into the world of predatory lending, high-interest divorce loans, and a new, specialized branch of the banking industry that began to treat marital dissolution as a distressed asset. The failure of a regulated insurance product opened the door for an unregulated shadow industry that would prove to be far more damaging to the American family than a monthly insurance premium ever could have been. In the next part, we will explore the rise of divorce litigation funding, the shadow industry that stepped in when insurance failed. We will look at how hedge funds and private equity firms began betting on the outcome of divorce cases, effectively turning the American courtroom into a casino. We will examine a specific case in New York where a financier provided millions of dollars to a spouse in exchange for a percentage of the final settlement, and how this investment model created a new, terrifying incentive to make divorces as long, as expensive, and as bitter as possible. The era of the policyholder was over. The era of the litigation investor had begun. To understand the magnitude of this shift, we must look at what happens when a major societal risk is left completely unhedged for nearly a century. In the world of finance, nature abhors a vacuum. When the insurance industry refused to cover the financial fallout of divorce, and when Safeguard Financial's modern attempt was dismantled by regulators, the risk did not simply evaporate. Instead, it mutated into one of the most controversial financial innovations of the early 21st century, third-party litigation funding, or as it is more colloquially known in the legal hallways of New York and London, divorce funding. Imagine a woman named Elizabeth in the year 2015. Elizabeth is married to a high-powered hedge fund manager in Manhattan. Their marital estate is worth upwards of $50 million, but the vast majority of that wealth is tied up in complex offshore accounts, carried interest and illiquid private equity stakes, all held in her husband's name. When the marriage collapses, Elizabeth finds herself in a terrifying financial paradox. She is technically a multimillionaire, but she has zero access to liquid cash to hire the elite legal team required to untangle a $50 million web. In the 20th century, Elizabeth would have been forced to settle for a fraction of her rightful share or beg the court for an interim distribution that might take months to arrive. But in this new era, a financier approaches Elizabeth's legal team. This is not an insurance agent selling a protective policy. This is a litigation investor. They offer Elizabeth $1 million in immediate cash to cover her legal fees and living expenses. The catch? The funding is non-recourse, meaning if Elizabeth loses the case, she owes the investor nothing. However, if she wins, or rather when she settles, the investor takes their initial $1 million back plus a significant percentage of the final settlement. This is not insurance. Insurance is designed to mitigate loss and restore the status quo. This is a speculative bet on the outcome of a legal war. Historical trends show that this model began to explode following the 2008 financial crisis, as investors searched for uncorrelated assets, investments that would not crash just because the stock market did. A divorce in a wealthy family is a remarkably stable asset for a hedge fund. People get divorced regardless of whether interest rates are high or low. By the mid-2010s, firms like Burford Capital and various specialized boutiques were pouring hundreds of millions of dollars into these domestic battles. From an actuarial perspective, they were doing exactly what the insurance companies had refused to do. They were pricing the risk of a divorce. But instead of charging a modest premium to a large pool of people, they were charging an exorbitant success fee to a select few. Step by step, this creates a system of perverse incentives that would have made a 20th century insurance regulator's skin crawl. In a standard insurance model, the goal of the insurer is to settle the claim as quickly and efficiently as possible to minimize costs. But in the litigation funding model, the investor's profit is tied to the size of the recovery. This creates a potential outcome where the financier actually encourages the litigation to become more aggressive and more protracted. If a quick settlement yields a $5 million payout, the investor makes a certain return. But if they can push the case to a $15 million judgment through 3 years of grueling discovery and expert testimony, their internal rate of return might triple. The financier is not a safety net. They are a silent partner in the destruction of the marital estate. Let's look at the hard math that replaced the insurance math. In 1960, a middle-class couple might have paid $20 a month for a hypothetical divorce policy. In 2026, looking back at the data, we see that litigation funders often charge interest rates or success fees that equate to an annual percentage rate of 30 to 50%. For the user, the cost of ensuring their legal victory is the loss of a massive chunk of their future wealth. This is the price of the 20th century vacuum. Because the insurance industry was barred from creating a low-cost, regulated product, the market produced a high-cost, unregulated alternative that serves only the top 1% of earners. For the American middle class, the situation was even more dire. A family in a suburb of Atlanta or Phoenix with a combined income of $150,000 and a house with $200,000 in equity is not rich enough to attract a litigation funder. The case isn't big enough to justify the funder's due diligence costs. Yet, this same family is too poor to self-insure against a $40,000 legal bill. This created what legal scholars call the justice gap. While the wealthy could borrow their way to a fair settlement using hedge fund money, the middle class was forced into pro-se representation or predatory high-interest credit card debt. Case studies from the 2010 to 2020 period show a direct correlation between the lack of divorce insurance and the rise of debt-funded divorces, where families spent a decade paying off the interest on the legal fees used to dismantle their own households. Consider the imagine-if scenario that haunts this retrospective. Imagine if, in 1985, the insurance commissioners had allowed the marriage endowment model to proceed. Instead of Elizabeth having to sell a percentage of her soul to a Manhattan hedge fund in 2015, she would have had a mature insurance policy that she and her husband had paid into for 20 years. Upon the filing of the divorce, the policy would have automatically triggered a $250,000 legal defense and transition fund. There would be no success fee, no interest, and no outside investor whispering in her lawyer's ear to keep the fight going. The existence of a regulated insurance product would have acted as a stabilizing force, providing liquidity without the predatory incentives. Why did the 20th century legal system prefer the predatory alternative? The answer lies in the deep-seated cultural resistance to the idea that a marriage can be valued as a contract. Even as late as 2020, many state courts were still hostile to the idea of selling an interest in a divorce settlement, often citing the champerty and maintenance laws, ancient legal doctrines from medieval England designed to prevent wealthy lords from sponsoring other people's lawsuits. Yet, the courts were slowly forced to allow it because the alternative was even worse: a complete collapse of the equality of arms in the courtroom. The system chose to allow hedge funds to profit from divorce, rather than allowing insurance companies to protect against it. As we analyze this from 2026, we see that the failure of divorce insurance led to a tiered reality of American domestic life. The wealthy have investors for their divorces, the poor have legal aid, and the middle class has catastrophic loss. The historical trends indicate that the absence of a simple insurance premium turned the most common financial risk in America into a tool for wealth extraction by the financial elite. The litigation casino became the only game in town because the insurance office was boarded up by moralists and regulators 80 years prior. But a new shadow is beginning to fall over even this high-stakes casino. As artificial intelligence and big data began to permeate the legal industry in the early 2020s, the investment model began to change. Investors no longer needed to guess about the outcome of a case. They started using algorithms to predict exactly how a specific judge in a specific county would rule on a specific set of marital assets. This brought us to a terrifying new frontier: the pre-computed divorce. In the next part, we will explore the rise of predictive marital analytics and how big data finally did what the 20th century actuaries couldn't. It turned your marriage into a spreadsheet. We will look at how Silicon Valley startups began selling stability scores to lenders and how your probability of divorce became a hidden factor in your ability to get a mortgage or a car loan. We are moving from the era of litigation funding into the era of algorithmic surveillance, where the divorce insurance that never existed was replaced by a digital scarlet letter that you didn't even know you were wearing. To understand how we transition from a total lack of data to the era of algorithmic surveillance, we have to recognize the fundamental irony of the 20th century insurance vacuum. For 100 years, the industry claimed that the American marriage was a black box, a private, emotional space where risk could not be quantified because it was too deeply hidden in the human heart. But as we stand here in 2026, that black box has been cracked wide open by the sheer volume of our digital footprints. The very information that 20th century actuaries would have killed for is now being used not to provide us with an insurance safety net, but to judge our creditworthiness from the shadows. This is the rise of the stability score, and it is the direct, unintended consequence of failing to create a regulated divorce insurance market decades ago. Imagine a couple named Thomas and Maria in the present day, 2026. Thomas is a civil engineer, and Maria is a high school principal. They have a combined household income that puts them in the top 10% of their zip code. They have never missed a mortgage payment, and their credit scores are both above 780. In the 20th century, they would have been the gold standard for any lender. But as they sit down to refinance their home at a lower interest rate, they are hit with a shocking rejection or worse, an interest rate that is significantly higher than the market average. When they ask why, the bank provides a vague answer about internal risk models. What Thomas and Maria don't know is that the bank's algorithm has detected a shift in their stability score, a proprietary metric that predicts the likelihood of their marriage dissolving within the next 24 months. How does the algorithm know? It doesn't need a confession, and it doesn't need to listen to their arguments. Simply looks at the data. Step by step, the predictive marital analytics engine ingests thousands of microsignals. It sees that for the last 6 months, Thomas and Maria have stopped making joint purchases at their local grocery store. Instead, their credit card data shows 2 separate, smaller transactions at different times. It sees that Maria has suddenly started spending more on career coaching services and has updated her resume on professional networking sites. It sees that Thomas's geolocation data shows him spending 3 nights a week at a gym 10 miles from his house, rather than coming straight home as he did for the previous 5 years. Individually, these are mundane data points. Collectively, when compared against millions of historical case studies of couples who eventually filed for divorce, they form a pattern of disengagement. This is the ultimate evolution of the 20th century data problem. In 1950, an insurance company couldn't tell if a couple was happy or miserable until the legal papers were filed. In 2026, the data is so granular that a machine can predict a divorce before the couple even admits it to themselves. But because we never established a legal framework for divorce insurance, this data isn't being used to help Thomas and Maria protect their assets. It is being used by lenders to protect the bank's own portfolio. From a lender's perspective, a divorce is a pre-default event. It is the most common reason for the sudden sale of a home or a sudden drop in the ability to service a high-interest loan. By identifying high-risk marriages early, financial institutions are essentially insuring themselves against us, while leaving us with no way to insure ourselves. Historical trends show that this kind of algorithmic filtering is the natural successor to the 20th century redlining practices, but instead of being based on geography, it is based on domestic stability. If you are flagged with a low stability score, you are effectively wearing a digital scarlet letter. The potential outcomes are devastating. You might be denied a car loan, or you might find that your credit card limit is suddenly slashed without explanation. This creates a self-fulfilling prophecy. We know from decades of case studies that financial stress is one of the leading drivers of marital dissolution. By raising interest rates on a couple because they might get divorced, the financial system actually increases the pressure on the marriage, making the divorce more likely. This is the ultimate moral hazard of the 21st century, and it exists only because we left the risk of divorce unmanaged and uninsured for so long. Let's dive deeper into the mechanics of this predictive marital analytics. In the mid-20th century, the industry struggled with adverse selection, the idea that only people who knew they were getting divorced would buy insurance. Today's algorithms solve this by making the rating involuntary. You don't sign up for a stability score. You generate it through your existence. Startups in Silicon Valley are now selling these propensity models to insurance companies for use in life and health insurance underwriting. Why? Because a person going through a divorce is statistically more likely to suffer from stress-related health issues, depression, or even accidental injury. The insurance industry has finally found a way to price the risk of divorce, but they are doing it by sneaking it into other products rather than offering it as a standalone protection. Consider the retail signal step by step. In a 2026 case study of a major big box retailer, researchers found that they could predict a household split with 85% accuracy simply by tracking home transition purchases. When a household that previously bought bulk-sized items suddenly switches to individual-sized portions, or when they purchase a second set of basic household goods like towels and silverware, the algorithm flags a household split. In the 20th century, this information was invisible. Today, it is a commodity sold to the highest bidder in the financial services industry. We have moved from a world where divorce was an act of God that no one could predict, to a world where it is a data event that everyone but the couple is profiting from. The ethical vacuum here is staggering. In the 20th century, we argued that divorce insurance was against public policy because it might encourage people to leave. But is it not also against public policy to allow banks and insurers to use our private domestic data to penalize us before a single legal step has been taken? The lack of a formal insurance product means there are no Fair Credit Reporting Act protections specifically tailored to your marital data. There is no right to see your stability score, and there is no way to rehabilitate it through marriage counseling or mediation. You are being judged by a machine that values your marriage only as a variable in a profit and loss statement. Imagine if we had taken a different path. Imagine if the marriage endowment ideas of the 1980s had been codified into a National Family Security Act. Every couple would have a transparent domestic risk rating that they could see and improve. If their risk increased, they wouldn't be hit with a higher interest rate on a car loan. Instead, their insurance policy would trigger a counseling benefit or a financial mediation voucher to help them navigate the stress. The product would be designed to save the marriage if possible, or provide a soft landing if not. Instead, by refusing to commodify divorce in a way that protected the consumer, we allowed the market to commodify it in a way that protects the institution. As we analyze the fallout of this digital surveillance, we find that the American family is now living in a state of pre-computed poverty. The algorithms are narrowing the window of opportunity for millions of people based on the predicted health of their relationships. The 20th century insurance giants stayed away because they feared the risk was too high. The 21st century tech giants jumped in because they realized the data was too valuable. This transition from blindness to surveillance has created a new kind of social class. The algorithmically stable, who get the best rates, and the domestic risks, who are slowly priced out of the middle class. But the most shocking part of this retrospective is not what the algorithms are doing to our credit, it is what they are doing to our choices. We are entering an era where people are beginning to gain their own stability scores, staying in toxic situations not because of social stigma, but because they can't afford to let their digital rating drop. We are seeing the rise of performative stability, where couples intentionally make joint purchases and maintain shared digital patterns specifically to keep their interest rates low. In the next part, we will explore the final frontier of this retrospective, the social credit of marriage. We will look at how the disappearance of traditional divorce insurance led to a new unofficial marital class system in America, where your relationship status is no longer just a personal choice, but a requirement for participation in the global economy. We will reveal the 2026 experimental city where marital bonding is being used as collateral for municipal bonds, and why the death of the individual might be the ultimate price we paid for the 20th century failure to insure the family. This unofficial marital class system is not a futuristic dystopia. It is the lived reality of 2026. The vacuum left by the 20th century insurance industry has been filled by a new, more rigid form of social collateral. Because we failed to commodify the risk of divorce through a transparent, regulated insurance product, the financial markets decided to commodify the stability of the marriage itself. This has led to the emergence of the Neighborhood Stability Index, or NSI, a metric that is now being used as the primary collateral for municipal bonds in several pilot cities across the United States. To understand how this works, let us look at the case study of a planned community we will call Viridiana, located just outside of Austin, Texas. In 2026, Viridiana issued a $50 million municipal bond to fund the construction of a state-of-the-art water filtration system and a private security grid. Typically, these bonds are backed by future property tax revenues. However, the investors who bought these bonds, pension funds and sovereign wealth funds, demanded a higher level of security. They required the city to implement a marital bonding requirement. This meant that every homeowner in Viridiana had to agree to have their domestic stability data monitored as part of their HOA agreement. Step by step, the financial logic is cold and efficient. The bondholders know that the highest risk to property tax revenue is not a market crash, but a wave of divorces. When a couple in Viridiana divorces, the house is often sold in a distressed state, the property taxes go unpaid during the legal battle, and the overall social capital of the neighborhood declines. To mitigate this, the bond is structured with a stability premium. If the divorce rate in Viridiana stays below 2% for the year, the city pays a lower interest rate to the bondholders. If the rate spikes, the interest rate jumps, and the city must pass that cost on to the residents in the form of higher fees. Imagine a resident named Christopher. Christopher is a data scientist who moved to Viridiana with his wife, Elena, specifically for the low interest rates and the high-tech infrastructure. But as their marriage begins to strain under the pressure of their respective careers, Christopher and Elena realize they are not just fighting for their relationship, they are fighting for their neighborhood's credit rating. If they divorce, they are not just losing their home, they are effectively defaulting on a social contract that affects all their neighbors. This is the ultimate death of the individual. In the 20th century, your divorce was a private tragedy. In 2026, your divorce is a municipal liability. Historical trends show that this is the logical conclusion of a society that refuses to provide a private safety net. When there is no insurance to catch the individual, the community is forced to become the insurer. But unlike a professional insurance company that manages risk through diversified portfolios, the community manages risk through surveillance and social pressure. This has birthed the phenomenon of performative stability. Christopher and Elena, knowing that their stability score is being monitored by the neighborhood's AI-driven financial monitors, begin to engage in a series of staged digital interactions. They make sure to post joint photos on synchronized social media accounts. They intentionally use their shared credit card for date night purchases at highly rated restaurants. They even use a specialized AI service that ghostwrites affectionate text messages to each other, knowing that the bank's risk assessment algorithms often scrape communication patterns for signs of domestic friction. This is not about love, it is about financial survival. They are hedging their risk of a higher mortgage rate by pretending to be in a stable relationship. The 20th century insurance companies feared that divorce insurance would encourage people to leave. The 21st century lack of insurance has created a system that forces people to stay in a state of digital theater. The economic data from 2026 suggests that this has created a bifurcated society, the marital elites and the domestic risks. The marital elites are those who can maintain the appearance of stability, granting them access to the lowest interest rates, the best insurance premiums for other products, and the most prestigious careers. The domestic risks, the single parents, the divorced, and the algorithmically unstable, are pushed into a secondary economy. They pay more for everything. Their car insurance is higher because they are seen as distracted drivers. Their rent is higher because they are seen as unstable tenants. This is the modern version of the 20th century credit score, but it is one that tracks your heart instead of your wallet. Consider the imagine-if scenario that could have prevented this. If a divorce insurance policy had been standardized in 1975, the cost of a divorce would have been internalized by the individual through a premium. The risk would have been managed by a third party whose only interest was the financial payout. There would be no need for municipal bonds to be backed by your marriage, because the economic loss of your divorce would already be covered. The insurance company would have been the buffer between your private life and the global capital markets. Without that buffer, the markets have reached directly into the home. We must also look at the impact on career advancement. In 2026, many Fortune 500 companies have begun using stability scores as a factor in executive promotions. The logic, as stated by HR consultants, is that an executive going through a divorce is a productivity risk. Case studies from the early 2020s showed that a contested divorce can cost a high-earning employee up to 500 hours of lost work time over 2 years. In the absence of an insurance product that could buy out this lost productivity or provide for a swift, mediated settlement, companies have simply decided that it is cheaper to promote the stable candidate. This has turned marriage into a professional credential, much like an Ivy League degree. This brings us to the terrifying concept of marital human capital. In the 20th century, we struggled to value the work of a housewife. In 2026, we have overvalued the state of being married to the point where the individual has no standing without their partner. If you are a single professional in 2026, you are viewed as a partial unit. You lack the stability collateral that your married peers possess. The historical trends indicate that we are moving toward a neo-feudalism, where the family unit is the only recognized legal and financial entity capable of accessing the full benefits of the modern economy. But what happens when the theater of performative stability inevitably collapses? What happens when the AI can no longer hide the reality of a broken home, and the stability score of a neighborhood like Viridiana begins to plummet? The potential outcomes are a new kind of financial contagion, a domestic subprime crisis. If a cluster of marriages in a bond-backed neighborhood fails at the same time, The resulting interest rate spikes could trigger a wave of foreclosures that look remarkably like the 2008 housing crash, but driven by domestic rather than predatory lending. As we reach the conclusion of this retrospective, we see that the 20th century refusal to ensure the American marriage was not a victory for morality. It was a failure of financial engineering that left the most important contract in human history exposed to the most predatory forces of the 21st century. We traded a $50 monthly premium for a total surveillance state. In the final part of this masterclass, we will summarize the lessons of this century-long failure and ask the ultimate question: is it too late to build a real safety net? We will look at the emerging decentralized marriage protocols on the blockchain that are attempting to create a new peer-to-peer form of divorce insurance, and we will reveal the one thing that no algorithm, no insurance policy, and no municipal bond has ever been able to account for: the resilience of the human spirit in the face of financial ruin. The final chapter is about the future of the American heart in a world that has finally, for better or worse, put a price on love. The emergence of decentralized protocols in 2026 marks the final attempt to solve the math that defeated the 20th century insurance giants. We have transitioned from the era of institutional trust, where we begged a company like State Farm or AIG to validate our domestic risk, to an era of algorithmic trust. In this new landscape, the very concept of divorce insurance has been replaced by something far more efficient and far more cold: the smart marital contract. This technology addresses the fundamental actuarial failure of the 1900s, the inability to manage moral hazard, by removing human discretion from the payout process entirely. Consider the case study of a couple named Jordan and Taylor in the year 2026. They are part of a growing demographic of professionals who view the traditional 20th century marriage license as an obsolete and risky financial instrument. Instead of relying on a state-issued document and the eventual intervention of a family court judge, they have entered into a decentralized marriage protocol on the Ethereum 4 blockchain. When they married, they didn't just exchange vows. They established a multi-signature escrow. Every month, a pre-agreed percentage of their individual incomes is automatically diverted by a smart contract into a marital liquidity pool. In the 20th century, if Jordan and Taylor had wanted divorce insurance, the insurer would have worried that the couple might separate just to collect a check. This was the moral hazard trap. But in the 2026 decentralized model, the payout is simply a return of their own escrowed assets, augmented by the interest generated through decentralized finance lending. The potential outcomes are governed by a marital oracle, a data feed that monitors their legal status, their shared bank accounts, and their residential filings. If the oracle detects a filing for dissolution, the smart contract executes a no-fault liquidation. Within seconds, the funds are split according to a pre-programmed ratio, bypassing the $300 an hour attorneys and the multi-year backlog of the court system. Step by step, this technology solves the indemnity principle problem that paralyzed 1950s actuaries. In the 20th century, insurance companies couldn't figure out how to make a person whole after a divorce because the loss was too subjective. In 2026, the smart contract doesn't try to measure emotional loss. It treats the marriage as a joint venture with a defined termination clause. By commodifying the exit strategy at the beginning of the union, the protocol removes the speculative nature of divorce. It is no longer a wager on the failure of love. It is a programmatic distribution of shared capital. Historical trends show that couples using these protocols report lower levels of financial anxiety, as the liquidation value of their marriage is visible on their digital dashboards in real time. Furthermore, we must look at the rise of conflict resolution DAOs, decentralized autonomous organizations, which have begun to replace the 20th century judge. In the 1990s, if a couple disagreed on the division of a specific asset like a house or a pension, they had to pay thousands in legal fees to argue in front of a human who might be biased or tired. In 2026, these disputes are sent to a pool of anonymous, incentivized jurors across the globe who review the encrypted data and vote on a resolution based on the original smart contract parameters. These jurors are rewarded for their accuracy and speed, turning the divorce adjusters of the past into a global, high-speed network of digital arbiters. This has reduced the time to settle a contested domestic dispute from 18 months to 48 hours. However, the most radical evolution of the 20th century vacuum is the experimental concept of universal basic divorce income, or UBDI. Some progressive economists in 2026 are proposing that since the state has failed to provide a private insurance market for 100 years, it should instead implement a national transaction tax on all marital financial events. This fund would act as a true social insurance, providing a guaranteed monthly stipend for 3 years to any individual whose household income drops by more than 40% following a divorce. Case studies from small pilot programs in Northern Europe suggest that this model effectively eliminates the feminization of poverty that we analyzed in the 1970s. It provides the soft landing that private insurers were too afraid to underwrite. When we look back at the 20th century from our current vantage point, we see a century of wasted potential. The 1920s moralists who banned marriage wagers, the 1950s actuaries who feared adverse selection, and the 1980s regulators who shut down marriage endowments were all operating under the same delusion. That by refusing to price the risk of divorce, they were somehow protecting the sanctity of the family. In reality, they were doing the opposite. By making the financial cost of divorce so high, so unpredictable, and so adversarial, they ensured that the dissolution of a family would be a catastrophic event rather than a manageable transition. The 21st century has finally accepted the truth that the 20th century could not. Marriage is both a sacrament and a high-stakes financial contract. To ignore the latter is to endanger the former. The absence of divorce insurance in the 1900s was a primary driver of the middle-class wealth erosion that defined the late-century American economy. It was a structural flaw in the engine of capitalism that forced millions of people to bet their entire net worth on the most volatile variable in existence: another human being. As we conclude this deep dive masterclass, we must recognize that the stability scores and marital bonds of 2026 are not just tools of surveillance. They are the scars of a century that refused to build a proper safety net. We are now living in a world where we have finally solved the problem of divorce insurance, but we have done so by turning our private lives into a public ledger. We have gained financial predictability at the cost of domestic mystery. The math has finally been solved, but the equation requires us to be more like machines and less like the impulsive, romantic, and unpredictable humans who first walked into those 19th century courtrooms. The retrospective on why divorce insurance did not exist in 20th century America is more than a history of finance. It is a history of how we learned to value ourselves when the institutions would not. We have moved from a world where you were on your own to a world where you are part of a protocol. Whether this is progress or a different kind of trap is the question that will define the next 50 years of the American domestic experiment. But even as the smart contracts execute and the oracles monitor our every move, there is one final frontier that the financial markets are already beginning to target. As we have seen, the domestic risk of the 20th century has been quantified, but a new, even more lucrative risk is emerging in the shadow of the longevity revolution. In our next deep dive series, we will investigate the financialization of the centenarian, looking at the terrifying rise of longevity default swaps, and how the insurance industry is now betting on exactly how long you can afford to stay alive in a world that has priced out the elderly. Stay tuned as we pull back the curtain on the next great economic shadow.